Markets are tough. Many people have lost money. Morale is low. So today we are here to provide you with all the information, research, tools, and frameworks to navigate these crazy times. And I'm very lucky to be with not only my brother from another mother, but also my business brother at SwissBorg, Anthony Lesoismier. So tell us, Anthony, what are you here for today so that the crowd can know?
Sure. So Alex called me 2 weeks ago and he asked me, how is the market, brother? And I said, that's tough. We're living in a very, very tough time. And even if we're in the business for 8 years now, I said that's most probably the toughest time we ever witnessed and lived. And he said, yeah, bro, I feel you. It's difficult for me too, but I want to help the community. I have this idea where this is in this tough time, but it's the perfect timing to go back to the basics. And I want to create content to not only help them to navigate the enormous amount of news that there is, but give them as well actionable insights and tools that they can go back to the fundamentals. Because this is, when you zoom out, it's not that bad. And I think that's what we are going to see today.
I love it. Helping the community is probably the most important thing and the thing that we love doing the most. And you're absolutely right. In winter, there's still sunshine. There's still things to do to get ready for summer times. And hopefully we'll get ready for the next big bull market where the altcoin cycle will resume and everybody will be back in the green. Look at this. We feel like we're at home. Anthony doesn't have his shoes on. I'm with my stinky socks. So very, very comfortable. Hopefully you guys like the format. If you have any feedback, by the way, because this is just a test run, right?
Yep.
We really want to understand, just throw information, content at you guys. If you do have feedback, please do not hesitate to put it in the comment section below. Like, dislike, whatever you can to help us, and so we can craft these videos for you and provide you with even better insights in the next episode, right?
Absolutely. And as you see, guys, we're here for a long run. We get very comfortable, and be with us. You're not going to be disappointed.
So let's dive into today's glossary and index of what we're going to cover. 5 components. And here we believe you'll have all of the information, once again, to provide you with the investor insights to make your decisions in navigating the current markets. So number 1, we have the money machine. Ooh, what is the money machine? Number 2, we have technical analysis, which is very simplified, basic stuff. Number 3, we have the investment strategy on a qualitative basis. But then number 4, on a quantitative basis with more mathematics. And by the way, Anthony, you were a quant, right? In
Exactly.
your early days.
Exactly, yeah. That's how I started to study the math of finance. And I think even though they don't necessarily always answer very, very precisely, right? It's I think there is a difference between building a plane, for example, where if you apply strict math and physics, you are most certainly of achieving the outcome that you expect, which is having the plane that is flying. In finance, it's different because you can apply the same tools. You have a bunch of tools that exist, but because at the end of the day, it is not the perfect science because it's psychology. And the output of the market is the combination of everyone's opinion that can never be forecasted for 100%. You have to use these tools as indicator. They have to guide you to take certain decision, right? But they cannot provide a perfect answer. That would be too easy. But there are very great tools that you need to use, especially in this very tough time. They help you to filter out the noise and to give you a clear signal. What is the things that, on average, regularly are working and I can apply, such as, you know, if you're a great boxer, you will do a jab, right? The jab would be your money in the bank when you don't really know how to overcome the opponent. So it's not a complex strategy, but you know for a fact there is statistics, there is enough reliance on this technique that you can rest within this specific technique. And that's what quantitative analysis help. They help us to gain clarity when it's very difficult. And that's the perfect tool for now.
Yeah, beautifully said. So you guys heard that. We're providing you with the tools. And I must say, when I see Anthony using like Excel or Google Sheets, this guy in terms of math, the way he sets up all the formulas, it's really trippy. It's so fast with all the shortcuts. So we have the right person in the right room for you guys. That's our whole point. And then the 5th component is to show you how to potentially use these investment strategies with the SwissBorg app. So hopefully you guys will enjoy. Do you like the agenda?
I love that.
Yeah, okay, fantastic. So without further ado, the money machine. Now, I would love to ask you, Anthony, before we jump into what is the money machine, would you agree that the money machine is the right terminology for what we're going to cover? And the reason why I ask you that is I call it a machine because sometimes financial markets can be artificially created, right? It's not always organic, and it's sometimes disjointed with the economy, and there are ways where financial markets can go up even though the economy is not necessarily looking good. So I feel like it's a machine, as in we can have different parameters. Is it the right terminology, or is it just overboard?
I think it's a very well fitted comparison. And when you look at the history of financial markets, even if you go back to Mesopotamia or back in the age where you can have a sense of a market, every different era of financial market has to answer to a specific narrative or a specific mechanism. With the invention of fiat currencies, more and more money become the predominant factor for markets. And it's especially true since we have this new effect of quantitative easing. So most of the financial analysis that you can do today, the market analysis, is driven by the analysis of liquidity, right? And as you say, it's a money machine, it's a liquidity machine.
Liquidity machine, yeah. Exactly. I was hesitating with liquidity or money. I was like, what should we put? What should we put? Yeah.
Yeah, and that's really what is driving the market. And when you understand that, then you can start to read all this news and we live in a world that is overflown with news and information. So you have to have framework. And as you say, the machine, because again, how does this modern machine that works? They work with data, right? So I think machine is very well adapted to money because of liquidity, and machine because we live in a world with so much input, which are called information. So they need to be processed through a machine.
Beautiful, great. So that's a good start, right? We have the right terminology. So let's have a look, guys. And by the way, I must say, and Anthony, I think you would agree 100%, today's framework is overly simplified. Obviously, It's a lot more technical, but if we go too close to the branches rather than seeing the forest, it's not going to help people today on giving them, as you said, some basic tooling to make decisions, right?
Absolutely. I think we didn't approach this theme and this video today as economists or a macroeconomist.
Yes.
So we don't want to be 1% loyal to the theory, or we want to provide you the necessary tools that everyone can use.
Exactly.
Very simple, very basic principle that you can use in your everyday understanding of the actuality to transform that into investment decision.
Absolutely. And to transform that into an investment decision, let's start, guys, with the 3 pillars for a bull market, and specifically risky assets. So here, if we look at the first one, we're going to cover some really basic geopolitics. And then if we look at the next component, we're going to talk about the US dollar, which is also the global reserve currency. And then we're going to talk about the Federal Reserve, which is probably the main component, the engine of this money machine, right? And I think in terms of the legend itself, geopolitics, so the presidents that will propose laws and policies, executive orders. We have the Federal Reserve that manages monetary policy, and we talked about the global reserve. And then when it comes to the legend itself, 2 arrows that we have in green what is directly controlled by something, and with a dotted line what is influenced. So far, and things may be not perfectly accurate, but would it be fair to say, Anthony, that we know that the president controls the executive order that also has influence on the Federal Reserve, doesn't control the Federal Reserve, but has influence because he can appoint people who are working for the Federal Reserve. Does that make sense?
Yeah, I mean, theoretically speaking, the Federal Reserve is an independent entity.
Yes.
So they are not a political entity, and I think they always start their speech with that precision. And so that's a very important thing to know. Of course, because Federal Reserve mandate is to decide on the monetary policy as a function of the economy.
Yeah.
And the first mandate is inflation. Unemployment rate as well is one of the variables they look for. And what you show in the graph is law and policy have a huge impact on how the inflation will react, right? So they govern how the economical machine of the specific country is going to operate.
Yes.
Right? And that has direct implication of both unemployment and inflation. Unemployment as well, traditionally in the past, used to influence a lot inflation. If you have low employment, you have less people are earning incomes.
Yes.
You have, it's very easy for companies to find people, so they don't need to increase salaries. The result of that is low inflation. When you have an economical engine that works in full regime, then the paycheck are going up.
Yep.
People can afford more, they can sell more, and then the inflation goes up.
So,
that the way it used to work traditionally. Now it's a little bit mixed.
Yeah.
Right? Why? Because we have automation. It's useless to talk about AI because it's a full entire new topic.
Is already,
So it's more mixed, and economy never worked perfectly according to mathematical formula or theories, as opposed to physics, right?
Mm-hmm.
So you cannot predict for sure, for 100% for sure. But there is influence.
There is influence, right? And that's really important to understand, guys. So once again, green arrows is control, direct control, and then dotted is influence. So you guys can see here, the Federal Reserve has direct control on Fed interest rates, which is a very important component to financial markets and bull markets, as we all know. So the president, for example, in this case, we're talking about Trump and his administration. Why? Because the United States accounts for 90% of financial markets, not only the stock exchanges, all the biggest financial institutions, right? So I think it'd be fair to look at the US as one of the main drivers of the financial markets, right? And then you can see here, so the president controls taxes, tariffs, regulations, which, as you said, is kind of the root cause for a lot of what the Fed does and the results of the economic indicators, right?
Absolutely.
In some ways. Right now, you guys saw the markets are very shaky. So stock markets crashed, right? Crypto, it's like some of the major assets lost 50%. So some people are saying, oh my God, it's already a bear cycle. Look at how we're getting crushed. And then there are few people, which you mentioned before, like Pompliano, who are talking about this FUD may be deliberate from the president to have pain in the short term, to maybe have more gains in the longer term. Do you see that as well? Do you think they have an agenda with the current administration and it's normal to go through some pain?
Yeah, it's a very legit question to ask. Of course, we have to speculate because we can never know for fact. I love the argument, but I think it's very clear that Powell and Trump, they're not best friends for sure, right? And I think in the first speech after Trump was elected from Powell, he mentioned that very clearly. His speech was somehow very offensive to what Trump can do. So Trump doesn't have a lot of leverage on the Fed beside trying to mess up with this indicator that we look for, which is unemployment and inflation. And tariff have a direct implication on this indicator. So as you say, he's trying to play with what is in his hand, right?
Yeah.
It's a chess match right now that he's playing with our money, with our emotion. But it's playing in real time, and we have to witness this, and hopefully it can be resolved into the most positive manner for everyone. But at the meantime, Republicans, they are very well known to play in the field of entrepreneur, of businesses, yes, right? So
absolutely.
Most of the time, and you've seen, right, they're already talking about potentially not applying any fiscal tax on crypto gains and this type of thing. So traditional Republicans, they have a policy that is at the advantage of capitalism, which means in return, there is less product for the economy because less tax.
Yes.
So there is less revenue for the country. So they have to compensate. And one of the ways to compensate is if you have a stock market going up, then you have more tax, people materialize more gains, and overall, your economy is still in a very, very positive territory, right? So I think it's not in that would be very surprised if Trump would not care about the market. So his strategy is, I think, to influence, to have the Fed bend to him, because part of his mandate as well was, part of his claim, and that explained the Dodge situation with Elon Musk and all this austerity that they practice, trying to having the state spending less. But there is only a limit of what they can do, right?
Yeah.
The biggest component of the deficit, the US deficit is the debt, right? So they have to force the Fed to reduce interest rate because that would cost them a lot of money. And Trump was elected on the promise that he will be the savior of the United States and starting to have the deficit going down.
Yeah, and he wants a surplus, right? Which is a crazy, target or challenge, but why not, right? Yeah. And I think a lot of people, for you to watching out there, so here we have a cool succession of events, right? We see that the fear, uncertainty, and doubt that Trump is creating in the short term potentially will increase the demand for bonds because people are afraid of risky assets. And by increasing the demand in bonds, that lowers the yields. We see it already in the 10-year yield, right? It's dropping. And by lowering the yields, it eventually will reduce government spending because they have to pay less on their debt. Is that pretty much how you see it unfolding, or?
Yeah, and it's happening. If you've seen, if you look at the moment Trump started to mention tariff to this day, the 10 years, US 10 years, have been going down.
Has already been going down, right? Yeah. And so I'd love to ask you, and you told me specifically, Anthony, that when the yields lower, the US dollar also weakens. So we can see this influence arrow going to the weak dollar. Is it important for us to have a weak dollar? If you don't mind kind of telling me why you wanted to connect these two dots.
Yeah, traditionally, there is an index that is called the DXY.
Yeah.
That is the US dollar versus a basket of different currencies.
Yeah.
And is usually seen as a strong indicator for market to go up or down. There is a correlation to that. And I think everything is linked. So it's hard to explain one variable.
Yes.
To say, because the dollar is weak, it means that the stock market will go up, or risky assets in general are going to go up. It's very hard, right? The thinking process is to say, if the US is going down, is because the rates are going down and there is more liquidity in the market, and there is more liquidity because, for example, the dollar is cheaper to borrow, risky assets should go up. Yeah. And we're going to see why as well. It's because most of the investors, they want to protect themselves from a currency that is perpetuating.
Exactly.
There's losing value in perpetuity.
Yeah.
So this is always very complex, and that's why this scheme, even we're starting to see a lot of arrows into this very simplification of what
and even this is simplified.
Even
so
this
it's
is
way more complex than that, right?
Yeah. But it shows as well already by the number of arrows that everything is so linked.
Yes.
By design, that is hard to isolate one variable. But we like to do that. We love to say, because this is going up, this will go up again.
Yeah.
Right? And everyone...
That's how we're wired, right? Cause, effect, cause, effect, cause, effect.
Exactly. We want one input for one output. Yeah. And that's why every macroeconomist or even in crypto, we have Raoul Pal, that is one of the most predominant figure. They're trying to say, okay, let's simplify to one metric. Yeah. And they use most of the time liquidity.
Yeah, M2, right? Yeah. Which is coming up next. Yeah. Okay. So, but thank you so much I think your message there is really important, guys, because you talked about how it has to be multiple indicators to really show cause effect, and you cannot take them individually, right? Because it's all intertwined, right? Yeah. In some way. So that's a really good point. And so we can see here, guys, so the government spending has an influence on multiple components, which are some that you've already mentioned. So we have energy, which is very important. We have employment, which you mentioned, which is very important. And we have GDP. And if we go a little bit further into what is this linked to, we have the CPI, inflation. We have employment, as you just mentioned earlier, about how employment was connected to interest rates as well. And then lower debt to GDP ratio. Are these, when we look at what the Fed looks like, these are really important indicators for the Fed, correct?
Absolutely, yeah, absolutely. That's part of the main mandate they have, is to have inflation below 2%, so that they are long-term mandates, to have good employment rate, and of course not to be in a recession. So GDP is part,
Amazing, amazing. And so here, guys, these factors are what the Fed looks like. So it has a direct correlation to the interest rates, right? Those numbers which we see in connection here. And then that goes, if we lower the interest rates, that has an influence, as you said, on the liquidity. Do you mind, Anthony, giving us a little bit of a very general explanation on what is M2 and what is global liquidity?
Yeah, M2, I mean, you can have a look, of course, on the Wikipedia and trying to understand better, but this is a metric that helps us to assess what is the current circulating liquidity, right, in general in the economy. And it's very basic. The way we have to think about it is the more liquidity there is, the more there is institutions, there is people, there is a bunch of economical agents that need to know what they do with this liquidity.
Exactly.
They don't want to keep the liquidity into cash because cash is losing value, right? So what they want to do with this liquidity is to invest into what they believe is the assets that are the more sustainable on the long term. So what are the assets that are not depreciating in value? And even if you look at Bitcoin, for example, of course, in the course of the past 10 years, right, we went from 1,000 to 10,000, 10,000 to 100,000 recently. If you look at this asset in dollar, but how much in the past 10 years the dollar has actually lost value, right? Mm-hmm. So if you start to look at Bitcoin, for example, in other assets, such as the gold, for example, right, you will see a different picture. If you look at the stock market, which is non-stop going up, and if you start to rebase the stock market into gold, you will see a very different picture as well. So yes, risky assets are going up in terms of fiat currencies, but fiat currencies are going extremely down as well, right? So you have to understand that informed economical agent, and you can be one of them if you adopt the right habits that we are here to help you with today. They want to escape the machine of devaluation of money. Yeah. So what they do with this extra liquidity is they invest, and they invest into assets that keep their value across time.
Which makes so much, and it's a great summary of how the whole thing works, right, Anthony? Because as you're saying, the dollar weakens, you don't want to hold cash. Bonds go down, you still want to make money, but bonds not bringing you back money. And then if you have a positive sentiment about the economy and interest rates go down, it's easier to borrow, then that liquidity will flow into riskier assets. Is that pretty much? Yeah. I know it's overgeneralizing, but
that's the way you have to see it. And even again, the most advanced people, they will explain it this way. If you have another supply of liquidity, you have to expect that risky assets are going to go up, right? And that's what we are seeing since 2008. Yeah. Before we transferred the public, into the private risk into the public risk, right? That when we decided collectively, the power in place decided to bail out banks. That was the moment where we started to transfer private risk into public risk. And the way we solve this equation is by devaluating the money. And since then, it's a ticking bomb. And every investor has his reflex to try to invest as much as possible into risky assets because they know for a fact that the cash they're sitting on is going to worth much less into the upcoming years. As normal economical agent, the way you feel it is real estate, right? Arguably, the real estate in every, at least in every developed economy has gone up crazy in the past 20 years.
100%. And that's exactly what I wanted to say. And going back to the concept of the money machine, I'm just going to quickly show you guys, and then the money flows into riskier assets, right? Just as the last part of this. And this is one last point I would love to share, Anthony, going back to the concept of the money machine, specifically machine, is because, for example, the bull run we had in 2020 to 2021, actually, the economy was really struggling. Like, it was a really bad economy. That's where most of the inflation happened. But because we printed money, because we did helicopter money, we're dropping money to people, there was more spending capital and flow liquidity to go into crypto. That to me is not a real strong economy. It's manufactured strong financial markets, but with a weak economy. And that's why I call it a machine. Even when we looked at the bull run after the bubble.com era, you could borrow money, like banks would pay you to borrow money. And so we had a really long bull cycle. even though the economy was not necessarily booming on all cylinders. And once again, that's why I call it a machine, because a lot of these bull markets are actually artificially created. Am I too critical on this, or what do you think?
No, absolutely not. I think again, I was too young because I started my career in 2008.
2008.
At the peak of the financial crisis. Actually, I started in 2007. But yeah, I mean, I think before quantitative easing and before the crisis of 2008, maybe I remember when I started into investment funds, there was what we call the value investor. And there was we have defensive stocks that usually perform well when the market is not that good. And we have more offensive stocks that perform very, very well into other markets. And I think the quantitative easing, there was something new, completely changed the picture. And now it's very much driven by liquidity.
Yes. You've
seen the stock market being ultimately driven by 7 stocks, right? We call them the 7 fantastics or something like this. Yeah. And so a bunch of the thinking process has been changed across time. And before it was very much value driven.
Yes.
And that's why guys like Warren Buffett, even though they are doing very well, they were such successful investor, and then things changed.
Exactly.
And most probably will change again, right?
Yeah.
So I think one day or another, this logic is going to break.
Yeah.
Because that's how economy operates across history.
Because it's a really good point, and that brings us to the next slide, which is where does the liquidity flow after this, right? But before jumping into that, I think you said something really important, Anthony, is like people usually invest or take risk when they have a positive sentiment of the future economy, right? The financial markets are usually always before the economy booms, right? Because they have to place their bets and make money as the economy booms, right? But as you said, because of this money machine, things got a little bit disjointed. And I'm going to give a prediction, guys. And it's not just for your moral support or even mental status to make you happy. But I'm going to say right here that I am super bullish, at least in 2026. And the reason why is because I think what Trump is doing here with the short-term pain is trying to heal the actual local markets or local streets before Wall Street. And I think he's really trying to solve some big economic problems that will hopefully reflect in the financial markets. What do they call it? It's like Wall Street and Main Street.
Main Street, yeah.
Yeah, he wants to solve Main Street to have a real Wall Street rally and a real economy that is not necessarily manipulated by the machine. So I'm just going to say, guys, I'm super bullish, but maybe, Anthony, you don't share the same feeling. You're kind of on the fence.
By nature, I think by working in the financial market and in crypto, you have to be optimistic. And I'm very happy to where we are, right, at the place we are. Now there is as well, it's hard to classify everything under the same umbrella. When we talk about crypto, there is Bitcoin, there is Ethereum, there is a bunch of altcoin, there is Solana. I think what we've seen during this cycle, which was not true in the previous cycle, is more dispersion.
Yeah.
Right? With the meme coin cycle, super cycle, I mean, it was promised to go much, much higher, but it still did a very good run, right? And and we have some of the coins that didn't perform at all. For example, gaming. There was a leading narrative in the previous cycle, didn't see anything, right? So I think what we are going to witness for sure is more and more dispersion into the performance of every assets. I guess not only, as you say, there is the macroeconomy that is heavily influencing overall the market, but as well there is trends such as automation, humanoids. I'm a huge believer that what Trump and Elon are trying to achieve right now, they are trying to automatize states as much as possible, which means we are welcoming from the White House, humanoids and AI and all this new technology to our economy, to our daily life. What are the implications at the economical level? That's very interesting. Maybe we are going to have it's already the case, but the predominance of companies such as Tesla, even though they're in trouble at the moment, but it's hard to imagine they're not going to be part of the picture in the upcoming years. Maybe they are going to be the biggest stock. Maybe Bitcoin is going to be, and few other assets are going to be the one making it in crypto? It's hard to know. I think that's I'm not questioning the assets in general. I think the good assets are going to increase in value. My thinking process goes back to understanding what are the results after this different cycle, what's going to be the effect on the dispersion of different assets that exist today and might be different tomorrow.
And that is the perfect segue. Look at this, Anthony. You literally predicted the next slide, which is, we saw in the previous money machine structure that liquidity would flow into risky assets, but we didn't talk about the stock market versus crypto markets. And I guess here, as you were saying, value stocks versus growth stocks, I think it was clear that a lot of the AI growth stocks that don't even have revenue models were pumping like crazy. Obviously, NVIDIA had a credible run as well. But then we have on the crypto side, I put innovative Web3 tech. And what I meant here, Anthony, is obviously there's speculation in everything, but I'm with you in the fact that if the economy goes better, then value stocks will go up in price because they're making more earnings, right? So better economy, more earnings for the company, meaning the stock price will go up probably for value stocks, which I believe could be the same for crypto, as in, rather the purely speculative, some of the fundamental tokens that also always need a component of speculation could go up. Am I wrong in saying that this is what we need for not just the liquidity to go into these risky assets, but to flow into crypto with just innovation, do things on Web3 that you can't do on Web2? Or how do we get some of this money to flow into our world and not just go into stocks?
Yeah, that's a good question. So, of course, we've seen in the past 12 months, ETF, institutional money. So there is a bunch of gateway for traditional investor now to be part of crypto. My understanding as well, an interesting factor as well is we've seen, for example, China having less and less debt, US debt. But in the meantime, we see the stablecoin market going up, which means that crypto is increasingly becoming a very, very important holder of US debt through holding stablecoin. Very interesting, right? So there is a bunch of factors that are happening that help to irrigate. I guess it's very clear as well that real world assets, I think Wall Street is eyeballing crypto. Why? Because the private equity and the IPO market is a little bit stuck. And they see a bunch of liquidity, they see a bunch of avenue to use the crypto market as a way to accelerate maybe the IPO market and giving birth to additional trading venues. Thing is as well, the crypto market is working all the time, which is not the case in the financial market, right? Yeah. So there is an appetite, I think, as well for people and generally investors to go to the crypto market because there's 52 weeks, right, in 1 year, 2 days, 2 days during the weekend. So it's almost a third of every year where traditional financial markets are not making money, while crypto is making money all the time. So it's significant.
And that is exactly, so my rapid fire question, you literally, you're one step ahead of the curve. So here we have, as you said, some of the Fantastic Seven, and you have on one side value stocks versus growth stocks, and then some stocks that may be in the middle, right? A little bit of speculation, but also revenues. But you mentioned something really important, Anthony, which is I put here what I mean in DeFi in the middle of as one of the sectors. DeFi, I would include RWA as a subsector of DeFi in general. Yeah. And then there's gaming and AI-Fi. I know you're very bullish on AI-Fi. But are these some of the sectors that you think bring the most innovation to Web3, or are we missing anything, some things that you're looking at that could help that liquidity flow into Web3?
I think definitely they are the pillar of where our entire industry is built on. Of course, trading is a big part. I think speculation is still the massive use case for crypto, and we haven't really crossed the level of maturity where we have other type of narrative or application that are helping to onboard more and more users. But of course, gaming is there is big hope, even though that was not the best performing narrative over the course of the past maybe 3 years now, which is a lot. And AI is new, but there's so many things happening at this level, and I think it's not going to go anywhere.
Yeah, I think you have a really good point. I tell people very often that I believe in the concept of a new bubble and a renewed bubble. So when a bubble comes back, there's still showing that we haven't solved the problem, we haven't found the ultimate solution, but there's demand. People believe there's something there, right? So as you said, the gaming concept hasn't renewed the bubble yet, right? We had a big bubble struggling to grow back, but yeah.
Cool.
Yeah. Awesome. So I think just to summarize everything on what we have here, I don't know if this makes sense, Anthony, but I tried to essentially look at it like seeing a P&L statement or a balance sheet, right? If we had to resume everything that an economy had to do with its president, once again, appointing the laws, the decision, executive orders. As of today, I would say that, as you said, Doge, they've roughly saved $120 billion, but they're going to have a limit. As you said earlier, it's not going to, they want to try to cut $2 trillion, which a lot of people believe it's not going to be feasible. But I put it in a positive. I put energy in a positive because, as you saw, crude oil is dropping, right? Where we've been dropping in the past few months. Reciprocal tariffs, I think it's more of a strategy that Trump's using. Consumption, so we can see consumption and foreign investment into the United States, $1.5 trillion, which is connected to consumption, right? And to employment, sorry. So I tried to put on what I see as a few positive indicators and then negative national debt, which $36 trillion is crazy. Government spending is still bad. Inflation has retraced, I think, from 3 to 2.8% or 2.7. So still bad. And the trade deficit, the US versus other countries, especially against China, is also very bad. But are there any things that you would add to this, or that you even disagree? Feel free to destroy my, you know what I mean? I'm trying to really take complicated things and make it as simple as a balance sheet. But
yeah, I think, of course, in the plus there is tax as well. But yeah.
Oh, taxes, yes. Yeah. Okay, so lowering taxes, which gives more, consumer spending power.
Like stock market, for example, right? If you have a very prosperous stock market, people are making capital gains. You can tax these capital gains, and that's why we shouldn't underestimate how much the stock market and market in general are very important for the US economy. It's a huge source of tax, for example. So income. Yeah.
That's a really good point. That's really good. And a lot of these terms here, like Anthony, when you look at them, almost every single word is connected to what the GDP is, right? And I think the GDP is a good economic health indicator, probably one of the most important, because it combines, as we see, consumption, investment, which we saw here, $1.5 trillion. But by the way, there's no president in American history that has received so much foreign investment in such a short period of time. So Obama had $1 trillion over the course of 4 years. Biden had $200 billion, something like that. So Trump definitely knows how to get people to invest in that. And so we see here government spending, net exports, that's what defines the GDP. So would it be safe to say that if we have strong economic signals, I don't know if this makes sense to you, that's what the investors are looking at, right? As soon as they see some indicators and it builds a positive sentiment for the future, then that would lead to, the signals lead to confidence, and then confidence leads to investment in a bull market. Make sense?
Yeah.
Okay, cool. All right, so next up, technical analysis. The second important component, there are many different, and you know these topics way better than I do, there are many different tools that we can use, right? Now that we've seen the macro side, the geopolitical side, the money machine, let's look at TA and the Fibonacci retracement from all-time high. Do you use Fibonacci levels, Anthony?
So the thing is I believe technical analysis is a great tool. I know people that are using it. We even have tests internally at SwissBorg where I contacted one guy that I was following for 1 year, and he's doing very well. And I invited the team. I contacted the guy. I said, it would be good if you can do a trial, because potentially there is value of offering your expertise to people in the company and at SwissBorg in general, to the community. So we ran this this Telegram group for a month now, and it's working very well. The guy is amazing, and he's using the Fibonacci. He's Italian, so maybe he's biased, but he's using it a lot. I'm lazy when it's come to technical analysis. I think that's something that you have to be in tune with. So I'm usually looking at people doing it. Right? I use other people's analysis to make my my opinion. But sometimes I'm impatient as well. Like you have to be like this fisherman, like looking at the right setup. But I know he's doing very well. Like the guy is doing very well. And I know a few other guys that are doing very well with it.
Yeah. And I guess today the reason why we're choosing Fibonacci retracement from all-time high is because, for example, Solana did reach an all-time high and it has retraced, right? Yeah. Just like a lot of the tokens, Bitcoin also reached an all-time high. It has retraced. So it seemed like a bit of a timely indicator that we could use, right? Yeah,
I think as well, when you look at the ratio of Fibonacci is 50%, 66%. So it's surprisingly, it's a lot of the, how can I say, the psychological number that we look at. Oh, I invest in this coin, I lost half of my money.
Half of my money,
right?
Exactly.
Or you feel really the pain when you have only 1/3 left, right? So there are funny numbers, because I think if you pay attention to the discussion you have, or even how you think with this raw number and then match very well what Fibonacci is giving.
And I think that's a really good component, because Fibonacci wasn't made for finance, right? It's a mathematical theoretician, right? Who essentially was saying that even nature, the way the flowers are built, the distance between a petal, or even the way our faces are built, there's some sort of number that seems to be all over, nature and the way things are built. So it's more than just an investment. I think Fibonacci, it's a very deep.
Of course.
So, but I think you're right. You can see here, like, I guess we wanted to stress here, we won't spend too much time, but essentially Fibonacci retracement from all-time high is just looking how low we could go. And I guess here specifically, you guys can see the yellow component. It's when it's retraced, as you said, roughly 50%. So here we have 38%. So I'll show you guys here. Minus 38% is the first level, and then 61%. And as you said, minus 50% is what they call the golden pocket. So Solana has reached in between minus 38% to minus 61%. And a lot of investors tend to invest in that golden pocket for the next rally. But there's some tokens that have retraced even more, right? That are under the golden pocket at the moment.
Yeah, absolutely. I think when you look at the altcoin market, it has bleed a lot. And there's another technical factor, I believe, that explain that. But I don't think it's a topic for today.
Yeah. So guys, feel free to use the Fibonacci retracement for timing your investment, I guess, if you think it's worthy. And the next component is talking about the qualitative side of the investment strategy. Now, this is going to be fun. It's a little more theoretical. We're going to look at some gurus. You can tell us, Anthony, which gurus you like the most. But the strategy that today we're going to reveal, which is a very simple strategy, I hope you guys are not like thinking we're going to reveal some sort of completely unorthodox or super scientific. It's a very simple strategy, but it's been proven by the best, I guess, is what we're trying to say here, right?
Absolutely. Going back to how we started this video, when you call me and you say we have to help investors, we have to go back to the basic. I think what we're about to discuss, which is auto invest, DCA, is to me is the most effective, not only in terms of result, but in terms of how much time do you need to dedicate doing it. That produce very, very, very interesting outcome over time. You have to be patient. But if you detach yourself from your impatience and this idea that you have to become rich overnight, but you truly understand that you have to invest in yourself over time, I think that's the most efficient tools that exist, that is available to you, that is as simple as having a Netflix subscription account, right? An account on Netflix where you have to pay a fees every month just to access. I think that's the Netflix of investment.
I'm going to go into philosopher mode, because I know you love philosophy, Anthony. Sure. One of your interviews with Kevin at When Shift Happens, you said finance is energy. It's a transfer of energy. I'll never forget that extract, sorry, it's one of the best parts of the interview. And you say the reason why finance is energy is because all the money that we earn comes through time, and time plus energy is what creates money essentially, right? So, and that's why I wanted to just stress the fact that it's not just about ROI, but it's about ROE, right? Return on effort. Yeah. Because that time is the most scarce commodity in the world, isn't it, right? We're limited in terms of time.
Absolutely. And I think what we're going to discover today is what would be required for you to create an edge in the market. You have to understand we operate in the most competitive market there is, right? Crypto is very competitive, stock market is very competitive. So for you to create an edge, you have to have a lot of time. You have to spend a lot of time, effort. You have to challenge yourself and acquire discipline. So in any case, DCA is already a very great tool to achieve some level of discipline. And if you want to challenge yourself in order to beat what DCA can offer, at least you have a benchmark, you have a reference, and you say, this is what I can achieve with the most simple strategy of all. And now if I invest 1 hour, 2 hours, 3 hours every week, every day of my time, can I beat this very simple strategy? And then you find out, and then you decide most probably to allocate your time better.
That makes so much sense. So let's dig into this, guys. So you don't have to trust us. You're going to have a look at some of the quotes from the biggest financial gurus in this history and the history of finance. So we're going all the way back to Benjamin Graham. And by the way, guys, if you like this format so far, please let us know in the comment section, right? How are you enjoying the flow of this interview? Be very, very honest so that once again, we can take that feedback on board and adjust for our potentially next, if you want us to do more of these in the future. So without further ado, let's jump into it. Do you want to read the first one?
Absolutely.
Anthony?
Okay, so time in the market beats timing the market. So from the intelligent investor Benjamin Graham, right? The famous one. So dollar cost averaging, DCA, means investing the same number of dollars each month or quarter when the market is low to reduce the average cost of your assets. Easy.
Makes sense, yeah.
Makes sense.
Makes sense. So Benjamin Graham, he's kind of a big deal, right? Yeah. He inspired Warren Buffett. I think all of the gurus of today are still alive.
Yeah, yeah.
So yeah, that's a pretty big name. I'll read the next one, guys. So you had it not just from us, but from Benjamin Graham. And next one is Peter Lynch, who wrote the book One Up on Wall Street, one of the best sellers in financial books history. He says, if you started DCA from the highest price per year, you can still beat those actively trading. I think something that you agree with as well, Anthony?
No, absolutely.
Next one, you want to take it? Oh,
I think before we get to Warren, I think even if you're not convinced, right? Because you say, I don't trust this guy, they write book, they want to sell me something. If you're in front of your computer now, you can go on TradingView or any things that give you a chart, and you go to the weekly time frame and you zoom out. You do that for Bitcoin, you do that for S&P 500, you do that for Nasdaq. You zoom out, zoom out, zoom out. You will see that the market is constantly going up.
Yeah.
So what does it mean? It means that the cost not to be invested because you want to time the market is high.
Yes.
And if every time you miss out because you actually were waiting for the market to go down and didn't go down, right? Then it means that most probably the more you wait, the more you will have to buy higher, right? So what these guys essentially are saying is the opportunity cost not to be in the market is so high that you better invest even when it's the highest of the highest, because it's a ticking clock. It's a machine that is keep making the chart going up. So if you wait too much, you wait 3 years. Look at what Bitcoin have done over the course of the last 24 months, right? So we went from 20 to 100. It's a 5x. If you are at 20, you are waiting for 10. Now you have to buy at 100, right? So I think that's essentially the message. So what Warren Buffett?
By the way,
is
if I
saying,
must say, Anthony, you just dropped some big facts there. We need to add Anthony Lesoismier, the barefooted guru, at the bottom. That was really good.
So you see,
great
we're having a
summary.
good time. So what Warren Buffett is $1 cost averaging investment be more aggressive when prices are low. Okay, good.
It's pretty good,
If you
right?
can afford, yeah.
Oh, there's one more for you. Sorry.
If you like spending 6 to 8 hours per week working on investment, do it. If you don't, then DCA into assets. And that's what we were saying, right?
Yeah,
Is
exactly.
what is the cost of opportunity for you, not to spend this money somewhere else, and how much alpha can you create. And even if we work together in this industry for 8 years, I started to work in the financial market in 2007, so it's been almost 20 years now.
20 years.
I had a shitty year last year, right? I really didn't manage to create an edge. If I was just passive, I had all my investment lineup, Bitcoin, Ethereum, few other alts. If I was going to vacation for a year, not doing anything, I would have done so much better.
Yeah.
But I tried
Same
to time.
here, by the way.
Yeah, I tried to sell and etc. And because the logic changed and I didn't adapt myself quickly enough, even though there was plenty of opportunities, I was not quick enough into understanding some of the aspect of the market. I was not confident enough on some bets that I've done, especially in AI, in virtual, where I was so very early on, and I saw very, very, very early, too early. If I was just DCA and not doing anything, I would have done much
Same
more
here,
better.
to be very honest. So this is good for me as well as a reminder. Actually, this is healing me, healing my pain. Alongside with just reading these things. So I'll take the next one, Charles Schwab, which, as you guys know, I believe was the first broker, right, to offer retail investments, right, where to invest in stocks via an application rather than calling up your broker, right, in the United States. So Charles Schwab, perfectly timing the market is impossible even for professional investors. I think it's impossible, right, to always time the market, right?
There we go.
Even when you read there's a book that I read. Have you heard of Market Wizards?
Yeah.
So that's a very famous book as well, right? A lot of the people who made a fortune, usually they just managed to time the market once, but they went big on that one, gut feeling like, oh, I feel like I'm right. Probabilities are looking good. They go all in either on a short, either on a leverage long, but when they try to do it again, it never happens again, right?
Yeah.
And so.
Yeah. Timing is something, money management as well. You can be right on the timing many, many times and never invest enough money. And by the way, that's a very, very known pattern into crypto, which is you invest very little when there is very little indication that, for example, the meme market is going to go up. But when it starts to go up crazy, you start to invest a lot because you feel like what will take you a lot of guts to invest. Like, for example, you will invest you will invest $10 and it will get you, it will be impossible for you to do the mental exercise to invest 1,000. You invest much more easily 1,000 when it's already the end, right?
Yes.
And most of the people lose not only because potentially they time wrong, but as well because the money management is extremely bad.
Yeah.
And it's hard,
It's hard, no one has a crystal ball, right? It's just like, I'll let you take the next one.
Yeah. So Vanguard, a great retail investor in the US, champions automated DCA for passive investor in all of his core content.
So it's more of a fact, I guess, right?
Yeah.
Vanguard, pretty big name, right? I think it's the second biggest financial institution after BlackRock, isn't it, in terms of AUM?
Potentially. You check your fact.
Yeah, please check your facts. And the last one of my favorite guys, by the way, Ray Dalio, from Bridgewater, which I believe is the best performing hedge fund in the history. I think out of 12 years, there's only 1 year where they were ROI negative. I forgot once again, don't call me on the numbers, but pretty good performance, right, with Bridgewater. He says Ray Dalio puts the same amount of money in his favorite stocks on a monthly basis. All right. So if you do not believe in these financial gurus who are pretty successful people, there's more to it, right? But a summary of all these quotes. So we have auto invest, so DCA, lower risk, higher gains. And then on the trading side, higher risk, lower gains. Less than 5% succeed. Is that true? Or is it a little bit more optimistic in terms of traders?
I think less than 1% succeed.
Less than 1%?
I believe so, right? Of course, it depends as well. What are the tools that you're using? Are you only trading spot? Are you trading perpetual, where you can actually obviously lose all your money? But one exercise that you can do is there is Binance that is a leaderboard, Bybit that is a leaderboard, even Hyperliquid as a leaderboard, right? So you take Binance, I think they claim they have 200 million users all across the globe. You go to their leaderboard and pretty quickly you'll see that the people with positive P&L is shrinking very, very quickly. Maybe after 2,000 or 3,000, already very, very low, right? So on 200 million users, it means that even if 1% was successful, that would mean 2 million of these people will able to show a positive P&L. I think we're very, very far from this figure. So
wow. So on Binance, roughly right now, it would less than 0.1% would be profitable. In terms of
it's been a long time I haven't checked,
okay.
But I think if you go to this leaderboard trader, you will see very quickly. They don't give you, of course, all the lists.
Yeah.
They maybe limit to, I don't know, 1,000 or 2,000 people to be ranked into this leaderboard. But when you see the figures, maybe the first guy has 30 million, then the next guy 20, 10. But as you scroll, you see very quickly you drop. And maybe if you look at the top 1,000, he has made 50K, right? So you can guess if you take the function of this P&L decreasing and you start to assume that will follow the same rules across, as we go down to the leaderboard. I guess you will see that, 0.1, less than 0.1%.
That's crazy. I definitely want to look at that. I'm curious. That's fascinating. And a great way to measure. I mean, you have all the facts there, right? And then, so auto invest, so DCA, very good for timing it here in terms of when to do it in bear markets, in corrections, I guess, to optimize your ROI, right?
That would be good. I think the optimal setup, I was about to do the math because we have a little math for you after.
Oh yeah, after we have it in a slide. Yeah. We can cover that.
But I think optimally, if you can commit to an amount of money, right? And when you feel you don't want to invest anymore, like now, this is where you need to double up because you can afford it. I think that's very good.
That's very good, right?
Yeah.
And the traders, they like high volatility, especially if it's in a channel, right? Because they just trade support resistance. Yeah. So that's good for traders. DCA is good for anyone, I guess. Anyone can do it, right? It's easy. It's open to everyone. You don't need, as you said, all the tooling. Well, traders is more, as you said, for advanced professionals. And then DCA can be as little as 10 minutes in an entire month or a quarter. While, as we saw in the previous slide, this trading can be, I put up to 10 hours a day, but it's even more than that, right? Like the real traders. I mean, I know people will spend 16 to 18 hours a day looking at charts.
Yeah. And you have to be ready for the quality of your life to change as well. People are trading actively. They wake up during the night because potentially we're in the US, right?
Yeah.
We're in the US, there is a Fed meeting, or there is the Japan.
Yeah.
Plays very important role in what is happening right now as well, right? Is what is their monetary policies heavily influencing everything because of the carry trade and stuff. But
literally, just to illustrate that point, Anthony, guys, I saw someone who moved to Dubai, who's an early bird. He loves waking up early in the morning, who's a trader as well, professional trader. He moved here just because he liked the time zone where he can get up early and he knows when the US, he's on time for US markets, and then then he can reach, European markets. And he literally moved here because of that time frame.
Makes sense.
Time zone.
Yeah, absolutely. So it's, you have to be in a position to afford yourself to do that. And there is a lot of mental work to do. Because as anything is, even if you know the theory, it's hard to apply in real time. And for example, the guy I just mentioned that we started this Telegram group with, because I believe that will be a great addition to what SwissBorg can offer to people that want to be more involved with trading and be more active. Yeah. His first advice was to say, when you start to trade, you have to journal. So you have to do your trades, your setup, or your analysis, and every time you take a trade and you close this trade, you have to go back to your journal and explain what happened. Because you do so many mistakes in the process. You know the theory, you know all the things, but something pushed you to do something else, right? So when you start this journey as well, you have to document, you have to do a lot of things to become this great
trader
ambition.
Journals are crazy, right? I see them, they document everything, the really professional ones, right?
Yeah.
which is, I do want to play the devil's advocate, Anthony, because we're talking about how dollar cost averaging is super cool. But if you actually search, you dive deep into investment strategies, especially in corrections, like the current markets that are suffering, there is a strategy which they call lump sum investment, which is someone who will go all in when the market is really bleeding at one shot. And apparently, according to Grok and OpenAI and all these tools, lump sum investing can actually generate higher ROI than dollar cost averaging, according to, there's so many numbers that's taken into consideration. But would you agree, Anthony, that even if lump sum investing may generate more ROI, there's a lot more stress to it to go all in, as in like in one sum, invest when the markets are bleeding, rather than dollar cost averaging, like in terms of stress? Or I don't know. I'm just trying to play the devil's advocate, challenge dollar cost averaging.
It's funny because when you ask me to look at the quantitative side of DCA, and I went to a few blogs that I know that are good, and they were discussing this topic. And there is great evidence from the past, from empirical data, that actually lump sum is much more effective than what DCA can offer. But I think there is a component that we're missing here is you might not have the money.
Yes.
What DCA allows you to do is you have a salary, you have regular income that are coming, right? So not everyone has a lump sum of cash to invest right now. As you said, there's a psychological aspect as well. So you don't want to burn yourself. I think the way you have to take investment is you have to take into account what is going to be the emotional impact in my life.
Yeah.
Because investment is supposed to give you a greater future, a greater way of living your life. But if you start to take too much risk, and it actually compress your quality of life in the expectation that in the future is going to create a better life, it's wrong, right? It's like when one of the famous monk, I can't remember his name now, but he say, it's funny when I look at Western world because they're obsessed about work. And then when they earn all their money, they invest all this money to heal their back pain. And it's a nonsense. I think the same apply with investment. You have to do it. Even sometimes I overdo it. But you have to do it to an extent when you know it's not going to impact too much the quality of your life. Yeah. Because otherwise it means you only live in the future, in the potential future, because we never know for fact. And sometimes it's very long before it can recover. So
my barefooted guru, that is some good stuff right there. To be honest, I don't have the gut. I can't do it. That lump sum, I read about it a lot. And when you have very high conviction, you go all in big amounts. I can't, because as you said, I don't want to trade off. I'd rather go the dollar cost averaging because I don't want to trade off extra stress. I already have enough stress in general life. I don't want to add to that. I want to live, life is worth living happily.
So I think if you're confident in your ability to keep generating cash flow in the future, this is very good, right? You can say, it's how much money I earn, this is how much money I need to live and doing my daily life, and this is how much money I can save. But for sure you have to invest it, because as we've seen, we don't want to have extra cash on the bank account.
Absolutely. And so here, guys, you saw most of the pros and cons, all the gurus, the qualitative side, and we're going to go a little bit more into the math. Thanks to Anthony today, who's providing us with some math, but I'll let you take over the market wizard versus the normal Joe. Cool. What is this?
Yeah, good question. So we just discussed framework, right? We discussed framework of how do we filter news and different contexts of what is driven our life every day, and we factor that into a framework that give us a very clear signal and insight, an actionable insight, actually, to transform news into actionable insights. Well, that's good. What you will find out though is macro and economy is such an interesting topic, but it's very, very intellectual. It's very passionating as well, because we learn about history, we learn about trends and great personalities, economists. But we touched base this topic already. Is if you want to save time, the conclusion is always the same. Our fiat currencies are designed to go down because we're so addicted on debt, and debt is heavily influenced by the cost of the debt is heavily influenced by interest rate, which means that eventually every country has to go again through a phase of QE, again through a phase of extra liquidity, which in return is making people that hold fiat poor, right? And there is this famous, if you go on X, or if you follow Michael Saylor, the famous Bitcoin guy, there is this interview where he say fiat holder, we have a name for that. We call them poor. And the guy, do the mix, we call them poor. It's a cool song.
It's so good.
So good.
Yeah. I was at a party the other night in Singapore during Token 2049, and they played the beats. You can imagine. And it was at the end of the night where people, they had a few too many glasses, so energy is a bit dropping. And the guy we called him poor. And everyone started standing up and like throwing their hands in the air. It was really funny.
So the conclusion of all of this, all these different frameworks, they lead to the same conclusion: is any excess of cash needs to be invested. Now we've seen DCA is fantastic to achieve such a goal. Question is can I do more than DCA, right? Is if I manage to create an edge, what can I have? Mm-hmm. So I play a little game here that gives you a first insight of, does it worth my time to try to create an edge? So let's see this match. So on one hand, we have the average Joe. What the average Joe is going to do, because they have no clue what to do best, is going to invest $1 every day into the stock market. No question asked. It's going to take $1 and invest every day into the stock market. Next to him, you will have a market wizard.
Gandalf.
So what happened with the market wizard is spend so much time studying the best books about investment that Wall Street gods grant him the superpower of predicting what's going to happen in the next day. So he's able to predict if a stock or a market is going to go up or down, right? Because he has this ability, when he knows the market is going to go up, he doesn't want to invest when the market goes up, right? He only wants to invest when he knows they are going to have a pullback, because he wants to have the best price possible. So he's going to invest $1 when he knows the market is not going to pull back, but when he knows that because he has this ability granted from the Wall Street gods to predict the future, he's going to save the
insider.
He has he has access to the superpower of insider. That's a good one. He's going to save this $1, and when the market is going to pull back, he's going to invest it all. Okay. So in the next slide, so these two guys, they're going to be in a death match for 50 years. During 50 years, as you can see in this chart from...
That's a long fight.
Yeah. From 50 years, they're going to apply both their methodology. So here's the little illustration to make sure I make myself clear. So as you can see here, there is a little zoom. You see the market is going up, but he knows, because he has the insider superpower, that it's going to go down. So in doing all this period that you can see is very long, multiple years, he's going to save $1 every day, and then reinvest everything back into this pullback. Superpower. And now we're going to see after 50 years, what are the results, which is the next slide. So the average guys, over the course of these 50 years, for 1970 to 2019,
no way.
Yeah, made by investing $1 every day, made approximately 170K of result. And what Gandalf, with his extreme superpower, managed to do is 200K, roughly 205K, right? Which is only, if you look at by year, it's only 0.4% of age every year, right? And the conclusion is, this guy is alone, doesn't have family, he dedicated his life to master and to get access to the superpower of insider power.
Look at all the white hair he has, right?
All the white hair. He looks super cool, but he's alone, right? Because he has to dedicate his life to get granted this superpower.
And women didn't want him, right? Because he was too busy in front of the screens.
Exactly. And for what? To create an edge. Of course, he's very proud because he is beating anybody else, but the edge is very small. And this guy didn't ask himself too much question, didn't spend too much time, select the right app, configure his DCA, and went to do something else, and still manage to achieve. an extremely good performance.
And he's having a great time with his bros, right? His crypto bros.
Exactly, wearing the good color. So that's the conclusion, guys. It's even if you are, and it's very, you have to imagine that it's impossible to create such an edge because no one has this superpower. I mean, some have, but for a limited period of time, not 50 years. And even with this superpower, you can see that there's a very, very small difference. I use this just as a source. As you can see, there is a source down. There is a great video.
You love that video, right?
I love that video. I think the guy is doing a very, very good job. So if you want to have even more in-depth analysis of this use case, you can go.
Maybe we'll put a link in the comment section or description, right? Yeah. So YouTube, James Shack. It's called "Don't Bet on a Stock Market Crash."
Do this instead. Yeah.
Okay. So my question to you, everyone, is it worth spending all that time for making just 0.4% extra every year and not having friends or enjoying life? It's a good question, right? Thank you, Anthony. That was very, very interesting. So what do we have here? Zoom out. This is kind of what you were portraying earlier, right? About if you zoom out, the market is potentially always going up.
I think that's essentially what we're saying is when we see such like when you zoom out, it's a great chart.
Yeah,
right?
it's a great chart.
I shouldn't stress too much. It's only when you zoom in, right, that you start to freak out. And I think Charlie Chaplin is saying something great. He said, when you zoom in, like when you're very close, life is a drama. But when you zoom out, when you step out from the picture, life is a comedy. Because he's a great comedian. And I guess the same apply here is when you get out from the drama of the average drama that we all victim of. I've been 20 years in the market. I'm still a victim of my own drama.
Yeah.
You have to invest that, right? It's just so clear in this picture, even though all the different news.
Yeah, and you have literally a catastrophic, like we're talking about, presidents getting killed, war, stagflation, another war, bubble, war. I mean, it just shows that everything will still be okay.
But it shows you that if you're consistent with your investment, with DCA allow you to achieve very easily, then you're going to look back and be happy.
100%.
Right? And that's with minimal effort. And I think for me, that's the best outcome of DCA. Of course, now we're involved in the game.
Yeah.
We become passionate. It's part of our life. That's how we earn our money as well. So we want to know everything and we have this curiosity. But I think if I was not deeply involved as I am into the financial market, that would be very clear for me after seeing this that, okay, have the discipline, be just more consistent and, zoom out.
If you're in doubt, zoom out. All right. And this is a mathematical. So this is the quants model. Previously was with stocks. Now you have something more oriented towards Bitcoin. Is that correct?
That's correct. Because we talk a lot about stocks. Reason being because they provide the longest right range of history. And the more you test against time, of course, we always say past performance are not necessarily meaning that future performance will follow the same rules. But I think if you are a data analyst, you will say the more data I have, the more consistent I can be about my output, and 50 years is a lot. Now we have quite a significant amount of data on Bitcoin, right? So I use a data period of 12 years, which is not nothing. But of course, it's less than 50 years. Right, cool. So going back to cryptocurrency, I wanted to do an exercise with Bitcoin, and I try to apply a methodology where someone will tell me, okay, that's good, but I don't want to invest for 50 years, right? I want to invest and regularly cash out money that I can enjoy myself. So I use the DCA within the context of someone that would say, I invest today, every week, but every year, every 2 years, every 3 years, or every 4 years, while I invest a week, 1 year before, I want to cash out. So I want to take the money that I invest, like for example, we are in the second or third week of March 2025. In the third week of March 2026, 2027, 28, 29, I want to take out my money. So let's analyze someone that want to cash out every year. So if you go back in history, 12 years of existence, of more than that in terms of existence, but the data I managed to collect was only 12 years. This is the result that you will get. So you will have invested 57,000 euro, and you will be able to profit. So profit, right? So it's not it's above the investment that you made. You will almost cash out 90,000 euro. Your best week, you will have invest 1,000 euro. So it's an investment of 100 euro every week. The best week you will have cash out 2,321, and the worst week you will have lost money, like 83 euro of loss. The frequency of your profit will be 72%, and the frequency of your loss will be 27%. If we move to 2 years, but you're not very committed, right? Because you want to cash out money every year. So it shows as well that what we see here is as we increase the number of commitments, so the more you are patient, the more you're rewarded. And you remember we say financial market in general, even liquidity cycle and Bitcoin as a consequence, because we have the halving. It's Raoul Pal said very, very clearly, there is 4 years cycle. And the coincidence is liquidity cycle usually are programmed on 4 years, which is as well presidential cycle, which is as well halving cycle. So there is this 4 years things that keep coming back into the financial market. I mean, crypto market, which is interesting. And we'll see here, this is where the highest reward is. 2 years, 200K profit, almost. Only 20% of loss in terms of frequency. 3 years, which is the amazing result, almost 2 million of profit, right? Just with the being consistent. 99% of profits and 1%.
Wow, and only year 3.
Yeah, so it means that 1% we have almost 500 frequency, so only 5 weeks where you will have to cash out a loss and very little loss. And 4 years, you've never been negative.
Never been negative.
Never been negative, right? 1% profit. So if you are patient enough to wait for 4 years, every penny that you have invested that didn't require you to invest all your lump sum and being very emotional about it, but just being consistent, will give you this type of earning, which is amazing, I think.
It's amazing. So investing just 100 euros weekly, so it's roughly 400 euros a month, which I think most people can afford to put to the side, right? To invest, right? I mean, 400 euros a month.
I think again, if I go back to Netflix, for example, it's 10 euro or 15 euro a month, right? So if you smoke cigarettes, most probably it's going to cost you. So I think you can find different savings that you can make. I wouldn't say it's for everyone, 100 euro, but you can do the same with 10 euros.
Yeah, with 10 euros,
And there is no, and that's the beauty of DCA, right?
And the most important is just to start, right?
It's
even more important than how much you put. It's just to start, as you say, even 5 euros, 10 euros.
Absolutely. And so I think, of course, we've seen stock market results are amazing. Bitcoin again, results are amazing. So
that's really, really good. So for those who did not necessarily trust the financial gurus earlier, here you have the math, right? It's very, very obvious. And as you said, and you did it in a 4-year cycle, which makes it very easy to understand. And I think to further stress your emphasis here, do you want to share a little bit about what it looks like with regards to weekly averages and on the chart?
So the last exercise that I've done, just to be complete, is to say, okay, we have this very simple DCA strategy, 100 euro a week. And here are the results.
For 4 years.
For 1 year, 2 years, 3 years.
3 years,
And 4 years. How this strategy, very simple strategy, where I invest 100 euro every week, right, for a period of time, how this strategy will compare with someone that try to be more sophisticated. So I'll try to explain myself. If you don't get it, it doesn't matter. You just have to look at this exercise such as you're very, very simple, normal Joe, being just disciplined, putting 100 euro every week, and you face someone that trying to have a better understanding of the market and trying to time again this market, create an edge, being better than what you can do, right? Of course, because we are in this, I try to simulate quantitatively. I use a very, very simple formula. So there is a concept in technical analysis or in quantitative trading that is called moving average. That is basically trying to understand what's the average of price. Here I use a 10-week moving average, but I use as well 20 and 30, and result was so similar I decided only to put this example here. But 10-week moving average means what is the average price of Bitcoin when I look back in the past 10 weeks, right? So which is 10 weeks is approximately 3 months, let's say, to be simple. If the price of Bitcoin is above this moving average, it means that traditionally speaking, in technical analysis, we'll see we're in the bull market.
Yeah.
If it's below, we'll say we're on the bear market, right? So the market is trending lower. If we are trending higher, which means we're in the bull market, I will only invest 50 euro in Bitcoin. You will invest 100 euro because you're normal Joe, you're just simple and disciplined. I will try to be smart. I only invest 50 euro and I will save 50 euro on my bank account. When the market goes down, trend down, which means that the price of Bitcoin cross to the lower, the moving average, all the money I've saved, I will put it into the market and will start to invest 100 euro until the market cross.
I like that.
The moving average up again, right? So I'll try to game the market. Can I be smarter by using money management?
That's really cool.
Into the DCA. So that's the exercise I've done. And if you move to the next slide,
and that's really simple to do. And by the way, for those who are out there who don't have the SwissBorg app, you should download the SwissBorg app because this can be done literally in seconds, which we're going to show later, right?
Absolutely.
But I think that's really interesting what you're saying, Anthony, because it's very basic adjusting strategies, right? You're adjusting according to where the market is. So maybe potentially, guys, in markets that feel quite bearish or heavily corrected, you can increase your daily cost averaging. Yeah. And then when markets are flying too much, you can maybe decrease the amount put into.
Let's look
you
at
have
the
it in the
results.
next one? Okay. Okay, sorry, you already have a slide for that.
So if we look at the results, because we're here to discuss quantitative stuff, we look at the over the period of 2017 to 2025, so 8 years. I remove price from the past because Bitcoin was, going too much high, and it was a little bit biasing the data. So it was not very good. So I zoom and I cut the data back to 8 years. Someone that will invest into the most standard DCA. Right, and you see they both invest the same amount of money over the course of this period, will make a performance of sorry, I'm struggling with numbers in English. 753%, right? 753%. And the smart DCA, so someone who will spend a lot of time, will actually underperform this guy. Yeah.
Wow.
So he will try to game. Of course, they stay very close.
Yeah.
But the amount of effort that you need to put into smart DCA, it's much higher than the standard DCA. And the amazing thing is, because the cost of not being invested is much higher than the cost of trying to time the market, your result, and I was surprised as well, but you actually underperform the guy that is just
that is
simple.
Crazy. So I must ask you, Anthony, in this particular case, so you're essentially saying that it's important just to stay consistent in your DCA, essentially.
I mean, if I was playing the exercise and I was saying, if it's trending lower, usually you invest 100 euro, invest 200 euro, find the extra effort, say to your wife, we're not going vacation, but don't worry, we'll go better vacation afterwards.
Yeah.
Or your husband. That will work for sure. That will produce an outstanding result. But in this case, I wanted to invest the same amount of money to be fair. And with trying to game the market by trying a sophisticated technique or trying to change the pure, simple, and basic discipline and spending time doing it, actually, you're not delivering a better result, which is very, very interesting. which make me think of Bruce Lee, right? Where he was saying, I fear a man that trained the same move 1,000 times, and not someone that knows 1,000 different moves. Right?
Yeah,
And,
that makes so much sense.
I think
Beautiful. Discipline and consistency. That is beautiful, beautiful. And so here we have another example, right, of Adam.
Yeah, I mean, that's more a closing thought. I think the essential, I think I want to connect back to both of the things that we discussed today, which to me are the pillar to simplify all this oversupply of information that we have on the market between macroeconomy and what's the best things to invest in. And at the same time, people are overselling trading strategy and edges. And, we have so much information to digest. But if we remove all the noise and we simplify all the message to the most essential messages in one hand, your money is losing value every day.
Yeah.
Every day, right?
Yes.
And that's the perfect illustration. If you take the S&P 500, we see the S&P 500, remember in this previous slide, going up, never going down or rarely going down. But if you now start to look at the S&P not in terms of dollar, but in terms of gold, which is a stable, an asset that is not dependent on monetary policy, you see the picture is much different. It's very stable.
Yeah.
So the corollary of that is, it is the visualization that, if I have dollar, sorry for my language, I'm losing money. I'm sitting on something that is constantly losing money. So every macroeconomic indicator and stuff will lead to this. That's the most important thing. If there is one thing you have to know is this. You need to have this feeling of urgency not to keep your money and invest, because this is the only way to keep your wealth coherent across time, as we see here. And it's not easy. The second part is the most simple way to do that, not to change completely your life and start to do things that are more complex. We already live a very complex life. Yeah. We are more in the process of trying to withdraw things from our life than trying to adding them. So try it if you need to add it, because that's absolutely needed. Make it simple. And simple is beautiful because it's very effective, as we've seen. So I use this slide as a closing thought of saying, you're losing money every day, but there is very simple tools that help you to curb, that help you, they offer you very simple and effective solution to change that outcome. And you don't have to be a victim, basically.
That's beautiful. Guys, let us know your feedback in the comment section below. We would love to hear more from you. And I think there's you wanted to add something?
No.
Because I think there's one more slide, which is the worst case scenario, right? And I think when you're seeing life in bets, or literally you taught me the concept of creating asymmetrical bets. Remember when we did the YouTube interview way back, which was an interview that really opened my eyes on so many levels. You talked about how a single day in life can absolutely change the outcome of the future of your life way more than an entire year, right? So you're talking about bets and asymmetrical bets. And I think this is really important, right? In finance, it's always good to look at what is the worst case scenario, right? To really be confident in placing the right bets, right? Because everything is risk-adjusted returns, right? And that's what most financiers do. So I took a tweet for you guys here, which I think is a very meaningful tweet from Scott Melker, who's a personal friend, who essentially demonstrated through this screenshot that if your timing was the worst timing in the previous cycle, so literally you bought Bitcoin at the dead top of the market, which was $69,000, and I believe it was end of October, early November 21, you would still be ROI positive roughly 6 to 8 months later by dollar cost averaging at the worst timing possible. Yeah. So that says a lot, right? So like even now, which I believe, as we heard earlier, I am super bullish. I don't know if it will play out by the end of the year or if the markets will start going in really bullish zones next year. I'm not too sure. I'm looking at Trump's midterm elections because he'll want to keep the Republican House and Senate. So I think that is a very important deadline for the president. So I feel like we're going to have a really nice rally before November 26th. when is impossible, right? We never know when, but I really am positive about this. But worst case scenario, guys, if we're wrong and the market tanks, another 50%, and the next rally, you will become ROI positive, essentially is what it's saying, right, Anthony?
Absolutely. Yeah. Basically, this is a very powerful case, and it shows you that even if you start, because you can ask yourself, is it a good time to start today, right? And there is no better day than starting today. That's basically,
or even yesterday.
Or yesterday, yeah. And that's what this scenario tells you is patience, discipline, and consistency will deliver.
Shout out to our friends at Crypto Glasgow. They say patience pays. Nice slogan, right? Yes. Patience pays. All right. So we looked at this one already. Now, the ultimate question, Anthony, is how do we do this, right? We've talked about many cool stuff. I'll just summarize the money markets, which had the macro, geopolitics, US dollar. Then we talked about the qualitative side, the financial gurus backing dollar cost averaging. We use a quantitative side, thanks to you. So we saw the math. And now, how do we do it? We're going to navigate the SwissBorg app, right?
Absolutely.
So without further ado, let's have a look. Here we have access to the SwissBorg app. We're going to dollar cost average in the Borg token because it's below the golden pocket. So we're going to choose auto invest, Borg token, and then we're going to search. Yes. And then we have the interval here. So we can choose 30 minutes, hourly, daily. We're going to choose weekly and start immediately. And then we're going to choose Swiss francs to buy the Borg on a weekly basis. We've chosen 1,000 Swiss francs. Tap OK, and then good to go. You have an activity log, and you can modify, right, your dollar cost averaging eventually, Anthony, right? So if you no longer want to keep weekly basis, you want to move to a monthly basis or daily basis, you can always adjust the frequency.
Absolutely, right? Yeah. And you can DCA out as well in case, for example, as we've seen in the previous slide with Bitcoin, you want to cash out every year, you can DCA out as well, which very few platforms offer.
And that's a really good point. So I'd love to ask you, Anthony, based on that information, and I know you don't have the perfect answer because no one knows the future, but some may think, oh, should I do $5 daily or weekly or monthly? And also you talked about like dollar cost averaging in and then potentially dollar cost averaging out. Do you see any different strategies that we could use with the SwissBorg app here, or it's hard to say?
Yeah, I mean, for sure, the frequency of the question is, even if I have $100 to invest every week, should I do 10 or 15 every day instead, right? And it's a very hard question to answer. And I guess, as we've seen, there is period of range, and what you can see is typically. But then we go back again to this notion of trying to time the market.
Yeah,
so
that's the problem.
We spend a lot of time as human discussing that. Why? Because you have to wait. Yeah. And I think it's hard to create an edge on the market. But if you want, I mean, there is still few scenarios where I believe you can forecast that there will be a movement with strength. Typically the type of range, like when the market is going up and down into a narrow range, like we are right now with Bitcoin to an extent, that is usually when the range is going to burst in one direction or another, the movement is going to be a little bit more violent. So in this scenario, you want to invest as often as possible. So maybe daily is more adapted if you've been very ranging for a period of time. But yeah, I think there is not only this is at SwissBorg, because we are a wealth management platform, we spend a lot of time trying to calibrate, as you can see, DCA to offer a different time frame for the convenience of everyone. But now the innovation is as well, you'll be able to DCA into a thematic. So it gives you, not only you are able to, because
that's a really good point.
Right? We've seen it's very effective on S&P or NASDAQ or Dow Jones, but this is not existing in crypto, right? There is no indexes. So you'll have to DCA in Bitcoin, which is most probably the gold of the digital world. And DCA on gold most probably is a very, very fantastic strategy. But if you want to DCA into an index or a diversified basket, such a thing doesn't exist. In SwissBorg, we have what we call thematics. That are basket of tokens. So already give you the ease of not having to select, to follow what's going on and potentially rebalance your portfolio. Everything is packaged under a thematic. What was missing is the money management element. And now with DCA into thematic that is about to be released, you have really the perfect settings to make your DCA strategy effective.
That's a really good suggestion there, because as you said, you can DCA into Bitcoin, you can DCA into Borg or whatever token you feel is undervalued, but you can also auto invest or DCA into bundles, which will directly diversify your portfolio. So even better risk adjusted returns potentially, right? And you talked about dollar cost averaging out. So maybe in a cycle where the prices are going bananas and people want to take profit. You also made a video, right? Dollar cost averaging out. So maybe we can have a quick look at that. So here, not just dollar cost averaging into your asset. So here we're going to exchange USDC. So we're going to sell Tau, is that correct? Into USDC. Okay, so we're going to take profits on Tau, and you chose the weekly frequency. Just there, a few taps, right? It was literally 4 or 5 taps.
Yeah.
And then you have the edit feature, so you can change the amount or frequency whenever you feel.
For the record, I'm still bullish on BitSensor.
Yeah, me too. So, it's just an example of dollar cost averaging in and dollar cost averaging out with the auto invest feature. But me too. I think that's one of the assets I want to lower my purchase price.
Yes. Let's see.
All right, guys. Well, I guess, we're getting close to the end. So last thoughts, something you want to say before we leave our beautiful community?
So yeah, it was a pleasure to do that with you, man. It's 2 hours or almost 2 hours. I don't know. We didn't measure the time, but a great pleasure to be with you here. Thank you for calling me, doing the effort. I know you put a lot of love and effort into this slide, and you walk the talk by trying to understand for yourself the macroeconomy and sharing it back to the community. So I think as well it's part of the investment that sometimes we overlooked, which is the sharing part. I think that's part of the pillar of SwissBorg. It's trying to share the love that we have for the space, the love that we have for humanity in general, with the community. And I think today is a great example. So if you guys love the format, I'll be very happy to, do that with you again. And thank you very much.
Thank you so much, brother. It's all felt equally, and always a pleasure to be with you and learn a lot from you as well. I got a lot of hidden gems myself, so it's always a learning process. And big shout out and love to the community as well. Once again, please listen to Anthony, share your comments and feedback. Do you want longer? Do you want shorter? Was this valuable for you? Yes, no. It's really important for us, right? Because or else we'll be creating content that maybe not fit. So please share your honest feedback. We really appreciate that. And if you like the video. And once again, I want to give another shout out to the team at Web3 TV who have provided us with this lovely studio. Yeah. I feel so comfy. I feel like home with this carpet, right?
Look at this.
Yeah, I'm ready to take a little power nap now. Thanks so much for watching, guys, and hopefully see you very, very soon.